Well, good morning, everybody, and welcome to the Scaleup Institute and British Business Bank Finance Education event for scale-ups in Yorkshire, Humber and Tees Valley and the North East. I'm Stuart Rock from Scaleup Institute, and I'm going to be your compere for today's event. Please excuse any croakiness in my voice. I've just been reminded that there's more than one variety of nasty flu-like virus than the most publicized current and recent edition. So I hope you have your coffees with you. Over the past 7 years, it's been a hugely exciting privilege for me to work with Irene Graham and her team at the Scaleup Institute, as they've made it a true voice of influence up and down the country, helping to make the UK the best place in the world to grow and scale a business. Today's event focuses on scale-up growth capital. What are the trends, where and how to find the appropriate capital for your company's growth, and to get a better understanding of the wider ecosystem that you can tap into for support. And we've got a terrific lineup and a wealth of knowledge for you here today. Obviously, if you have any questions, always just put them in the chat. First, today, you're going to hear from Irene Graham, the CEO of the Scaleup Institute. After Irene, we'll hear presentations from Sean Foy and Mel Elyard from the British Business Bank, and then from Maxine Adam from Innovate UK. And after that, there's going to be a panel session, which we'll first hear from David Craig, the CEO of the Sheffield Tech Scale-Up Isotope, as well as from Bob Bugbee of London Stock Exchange, Barry Jackson from BGF, Ben Tickler from Silicon Valley Bank, and James Thompson from FinCap. The whole session will finish at 11:30 on the dot, and we'll make the slides available to you afterwards. So don't worry about taking screenshots and scribbling furiously. Just let the coffee percolate and let your questions come forward. So without further ado, my great pleasure to hand over to Irene Graham, CEO of the Scaleup Institute. Irene.
Good morning, everyone, and fantastic to have all of you with us today to discuss Scale-Up Capital. You are, in the audience today, a very important part of our economy. Our scaling businesses are truly international, global, and also our innovators, as you'll hear across this morning. You're adding to the jobs every day in the UK economy. And when we look across the UK economy, you really are our growth champions. We have across the UK 33,445 scale-ups, businesses growing at 20% or more year on year in either employment turnover or both. And we have a very healthy pipeline of around 17,000 growing at the 15% and above. And that group of companies is 50% of our small and medium-sized enterprise economy. That's why it's so important that when we talk about the SME economy, we actually distinguish the scaling businesses within it and are really focused on the needs of the scaling businesses, those of you in the audience today, and what your requirements are. In the North East and Yorkshire, we have nearly 6,000 scale-ups across the two areas, 500,000 in employment, generating nearly 75 billion in actual economy and revenue into the locality. So incredibly important to the local economy, incredibly important to the overall economy. And we have a really interesting group of clusters emerging in the regions that you're a part of. Clusters and fostering those clusters and developing them are really important. And it means that you've got peers who are scaling on your doorstep, and how you get connected to them and working with them is always something that you stress to be important to ourselves. So you can see that dynamic of the clusters, where it's in life sciences, the creative sector, whether it's in accommodation or general tech or finance. There's a lot happening in the North East and in Yorkshire and Humber and Tees Valley areas. Most importantly, what the Scaleup Institute is about is making sure we address what you, as our scaling businesses and the CEOs and leaders of those businesses, want to see from the private and public sector. And that's what we've been focused on for the last 9 years in making sure the private, public and education sector can really step up to the needs that you have. So when we talked to and interviewed around 80 of you this November in 2021, there were some critical things you actually were very clear that you needed to see continuing to be broken down in your growth journey. Firstly, there's the access to markets environment. How do you get connected to the right customers, both at home and abroad? Then there's dealing with that talent issue and getting the right skills into the company, whether it be at the get-go from school and college, or indeed from an ongoing basis and into the leadership level. Very important to you is what you have available in terms of board members, in terms of mentors. And very critically, you're very clear that growth capital is a priority for you, and that you are concerned about the level of capital or connection to that capital that you can gain. And that's why that's the focus today. You're very focused as well on getting connected to the financiers, and you're going to hear from a number of them today and this morning. And then also you're going to hear from the British Business Bank and Innovate UK. Critical factors, R&D, innovation, and that linkage to Innovate UK, very high on your agenda. So you'll be hearing from them shortly this morning. And as I say, how the British Business Bank is seeking to address the funding gap. If we really drill into your requirements in the region, 8 in 10 scale-ups in the Northeast are using external finance, 9 in 10 in Yorkshire and Humber. But many of you feel that finance that you need for the next stage of growth, and you're not feeling that you've got sufficient capital yet to meet your growth ambitions. Many of you also think that capital is residing in the Southeast. So we are looking at how we get that capital better connected to you, that you can hear about the opportunities for raising funding. And you're hearing from a range of leading experts this morning who will give you insights into that. We are very focused on how we connect growth finance through what we call the escalator of finance, right from the early stage risk capital, which might be angel capital, it might be great grant funding, through to the venture capital, through then into the patient funding, VCs, crossover funds, and then eventually right up into IPO. That's what we need to do, is make sure that's really connected and the right depths of capital are available at every single element of that, and very much so locally connected and in the regions available to you. So that's what we're very focused on. We work very closely with a range of your colleagues in the region. The North East and Leeds City region are doing some really great things in relation to growth capital and also scale-ups, and the Scale-up North East programme, what Leeds City region are doing with their business school and the local environment. They're very focused on how they support scale-ups, and you can learn more of that from our website and business support finder. We look at what's working for you as scale-ups. We look at what works to address the gaps, and therefore what schemes you can look to apply to. And we also are looking at how we give you the insights to raising capital, whether it be in specific sectors or across specific regions. And you can see some of the players in finance who are funding businesses locally at the moment. So that's our remit, to make sure that we ensure that you as scale-ups get the services that you need, and that we keep the public and private sector focused on that. It remains for me to say this morning, I hope you get what you want from this session. As Stuart said, please keep questions coming in the chat box. We're here to help you and address your questions today. And above all, keep energizing, keep scaling, and keep doing what you do for the local economy. So thank you for coming today. I hope you get what you want from it, and we're looking forward to speaking with you going forward as well. At that point, I will stop and hand back to you, Stuart, and our colleagues at the British Business Bank, who are very happy are working with us on this initiative.
Brilliant. Thank you, Irene. And just here's a simple handoff over to our colleagues to Sean and Mel at the British Business Bank. Floor is yours.
That's great, Stuart. Thanks for that. And I'd like to welcome everyone to the event this morning. My name is Sean Foy, and I'm the UK Network Manager for the British Business Bank in the North East of England. I'm also joined by my colleague Melanie Elliard, who is the Network Manager for Yorkshire, Humber and Tees Valley. And we'll just run through some of the work of the bank this morning, generally within the UK, and also Melly will cover some specific points about the region. For those of you who are not aware, the British Business Bank is the UK's development bank. We're owned by BEIS, Department of Business, Energy and Industrial Strategy, funded by the UK Treasury, and we've been in existence for a little over 6 years, 2015. And our role really is to try and help businesses access finance and funding across the UK and that transition towards a net zero economy, supporting them in that move. And for me, it's very much a case of doesn't matter where that business is from a geographical point in the UK and what stage they're at, whether they be pre-start, startup, scaling businesses we're talking about today, or a later stage business, that they can access the funding they need, but also that they're fully informed about their funding options, and so they can make the right decisions for their growth aspirations and goals as a business. If we move on to the next slide, please. We're talking specifically about the Scaleup programme today, and we have a number of programmes operating across the UK. There's around 2 billion of finance supported, nearly 800 businesses. And I'll pick on, first of all, the Regional Angels programme, if we could just move on to that. Next slide, thank you. And the Regional Angels programme, been in existence a little over, I think it's about 18 to 24 months. There's actually now 10 investments made under that programme, so I have to get the slides updated on this one. But what they're trying to do is address that regional equity gap in that early stage investment process. What we do still see is there is still a focus within Angels working in this sort of golden triangle, London, Oxford, Cambridge. We're trying to break down that imbalance and work with angel groups so they invest regionally. Just recently in the budget, it was announced that a further 150 million has been committed to this programme to further continue the great work of the Angels programme, so we can create a more diverse funding market and that businesses in the North East, Yorkshire, Humber side and elsewhere can access funding, and they're not forced to look down to Angels in London and the South East. If we move on to the next slide. We also have our Enterprise Capital Fund programme, a $1 billion programme that's trying to work really with new VCs that are entering the market that want to support early stage UK high growth companies. There's around 35 billion that's been committed on that programme, where we're drawing in funds from those VCs and other funders to try and work in that space. And you'll see nearly 600 businesses supporting that programme. We'll move on to the next slide. And I wanted to highlight a little bit of work of British Patient Capital. So Patient Capital is a separate group within the bank. It was born out of the Patient Capital in 2017 that identified that there were significant issues with regard to businesses seeking follow-on funding in the UK. There was a similar number of businesses in proportion to the US, but they don't receive the same amount of funding going through those additional funding rounds. And Patient Capital was established to try and address that. We'll just go on to the next slide. £2.5 billion fund, working with fund managers across the UK, about $1 billion committed, a little over $1 billion committed so far. And what they're trying to do is change that dynamic in that funding model, as it were, so that those businesses seeking follow-on funding get similar amounts, larger amounts, equivalent to what you see in the US market. Move on to the next slide. I'd also wanted to highlight the work of our Future Fund Breakthrough Programme, new programme that was announced last year, 375 million, trying to work with companies that are really working in that sort of breakthrough technology space. It's later stage funding because the minimum investment round is 30 million. But what we're trying really to do there is support that innovative economy that we have operating in the UK and real specialisms in tech, deep tech, fintech, etc., life sciences and so on. So move on. We also have a specialist life science programme now, again running through British Patient Capital, 200 million of funding, trying to again marry in private capital, further 400 million we hope to draw in from private investors, really trying to support those companies in that life sciences space, and particularly relevant in my region, the North East, where there is a significant life science presence centred on Newcastle University and the Centre for Life. We'll move on to the next slide. And I've now had to hand over to Melanie, who will take you through the impact of some of our programmes in our respective regions. Melanie?
Lovely. Thank you, Sean. And hi, everybody. Yes, I'm Mel Elyard and I look after Yorkshire, Humber and Tees Valley. I'm going to take you through a few slides that talk about the Northern Powerhouse Investment Fund and a couple of slides that talk about really the impact of British Business Bank on Yorkshire and Humber and the North East. So the Northern Powerhouse Investment Fund is a 500 million fund, and it was set up and it looks after businesses that are based in the Northern Powerhouse region. And since its launch in 2017, it's provided key investments for growing and scaling businesses of all kinds across the north. It's supported, and we work really closely with 10 LEP areas spanning the Northwest, Yorkshire, Humber and Tees Valley. Moving on, the investments are delivered via 3 funding options. So we've got microfinance, and we have fund managers that look after microfinance, and this is loans of between 25,000 up to 100,000. And the microfinance fund managers in the region are Finance for Enterprise, and they look after the Sheffield and the Humber region, along with Business Enterprise Fund, who look after Leeds City region, York, North Yorkshire and the Tees Valley area. We've got debt finance, and that's loans of between 100,000 up to 750, and they are delivered by Mercia Debt in Yorkshire and Humber, and by FW Capital in Tees Valley. And finally, we've got equity finance of up to 2 million, and that is delivered by Mercia Equity Finance. As I've already mentioned, these funds are available to a wide range of businesses of different sizes across the whole of the north. So really great fund to have in the region. And moving on. So I really like this slide because it's a really good news slide. It's a little bit out of date already. I think this is as of let's have a look, end of January. But essentially what it's showing us is, of the fund, over 300 million has now been invested. So we've hit the 300 million mark, with a significant amount of private sector co-investment of 400 million. So a really great total, 700 million invested in businesses across the northern region. And I think, it just kind of makes us realise that 1 billion mark is a real possibility over the life of this fund. What does that mean? It means 1,280 investments into 952 SMEs in our regions. And probably no surprise when you look at the geography and what happens in the region, but manufacturing has been the most active sector today. Moving on, we've got a really nice success story, a Redcar-based clean tech company called Nova Pangaea, who've had a lot of press and publicity. They're doing really well. And they're a great example of the impact that the Northern Powerhouse Investment Fund can have on regional businesses. They've secured 3 rounds of funding from Mercia Equity Finance. And with that funding, it's enabled them to commercialise their technology further, create a really good amount of jobs into the region, and showcase Tees Valley not only regionally, nationally, but internationally as a leader in decarbonisation. And they've even got a mention in the recently released Levelling Up paper, so that's really nice to see. There are absolutely loads of case studies on the Northern Powerhouse Investment website from all sectors, from all the different regions. So if you are interested, you can go in and have a really good look at what sort of deals have been done and continue to be done. So moving on. Again, more good news for the fund. In the spending review recently, it was announced that the next generation of Northern Powerhouse Investment Fund will grow. It will be a 660 million fund going forwards, and it will also expand into the northeast. So it will cover Northwest, Yorkshire, Humber, Tees Valley, and the northeast, which is really good news. So we can continue to do the great work with local regional businesses. We haven't got all the details yet, that's all in the making, so please don't ask me exact timeframes for the delivery of things, but this will all come out in due course. Next slide. And now just a couple of slides really looking at the North East and Yorkshire in terms of impact from the bank. So first of all, we're looking at the North East, and there's been 181.5 million of finance supported by bank programmes into the region. And that's supporting just over 2,000 businesses regionally. Nearly, well, notching up to 60,000 COVID loan scheme facilities have been delivered, worth over 2 billion into the region. So some big numbers there. And then finally looking at Yorkshire and Humber, 562.2 million of finance support into the Yorkshire and Humber region, supporting over 5,000 SMEs. And I think it's really worth mentioning here that the startup loan company have been and continue to be highly active in all regions. And here you can see they've delivered over 19 million in loans to over 2,500 SMEs. And that's really important because these are entrepreneurs that are starting their journey, that are starting these exciting businesses, some of which would have classed themselves as unemployed had they not started a business through startup loan company. So I'd be interested to see what happens to these businesses going forwards. I think the only thing really left for me to say is that, you know, we don't do this alone. We do this with the support of key stakeholders and our delivery partners, which is really important to us. So yeah, we're looking forward to a really good panel discussion. And please, if you've got any questions, pop them in the chat section, and we certainly pick up on them. So I'm going to now hand back to Stuart, I think.
Brilliant. Thank you, Sean, and thank you, Mel. It's a very good, comprehensive overview of all the activity that the British Business Bank is engaged with here. Just interested, Sean, one of the points you referenced earlier about the Regional Angels programme. Are you encouraged by seeing further the increase in a number of local angels?
I am, yes. I think, you know, to put it in context, I joined the bank 3 years ago in 2018, and there were very few, if any, angel groups active in my area, the North East Left Patch area. You had 1 or 2 individual investors. I've now seen 3 active angel groups now active up here, with a degree of encouragement from ourselves that they're not currently part of the Regional Angel Programme, but I'm sure it's something that they will be looking at in due course. And I think also there's been an acceptance by businesses that actually looking at early stage equity is an option. Sometimes I found when I first took on this role back in 2018, a lot of entrepreneurs were resistant to looking at equity. They would gravitate towards debt because that was the traditional way of doing things. But I think there's a greater openness now, and you're seeing a lot more businesses seek equity, early stage equity, angel investment, and a lot more high net worth individuals. And we have many in the North East who are successful entrepreneurs and still either in business or exited and looking to reinvest in you know, high growth companies coming forward. So I take heart from what I see in the last 3 years, to be perfectly honest. It's a very different market to what I saw originally, certainly, Stuart. Yeah.
That's a very encouraging conclusion. Thank you. So, Sean and Mel, I'm going to switch you off, and you're going to switch yourselves off. And it's my pleasure to introduce Max Adam. Great pleasure to introduce her from Innovate UK. You're lucky today, as few people know more about how innovative scaling businesses can be supported than by Max. So over to you, Max.
Oh, gosh, that's a great introduction. But I'm really delighted to be here today and to be part of this discussion, and to be able to give you, my brief is to give you a whistle-stop tour about the various ways that Innovate UK supports our UK innovators. so the businesses like yours, to get those services and technologies to market. Innovate UK is part of UKRI, which is made up of the UK's 9 leading academic and industrial funding councils. So they invest collectively north of 7 billion a year, partnering with academia and industry to make their mission is to make the impossible possible. So, you know, a real grand mission. This provides us, though, with unique relationships and connections that we leverage on behalf of the businesses that we work with. But at Innovate UK, as part of UKRI, our role is very specific because we're charged with helping to drive economic growth by supporting the businesses like yours to develop and realise the potential of their ideas. And that's the mechanism that we're charged with using to drive economic growth and better societies. So that's what we do. And we do it mainly through funding, competitions, grants and loans. These include a variety of routes, from specific grants for single businesses through to procurement contracts for R&D. We're latterly, in the last few years, expanding how we provide funding and now offer innovation loans and investor partnerships, which are an increasingly focused area of how we intend to support businesses. And to help make sure that funding drives a better return for the public purse, we are publicly funded to get a return on that investment for your tax pounds. We also provide wraparound support, which is tailored to the needs of those R&D and innovation-led businesses that we fund and work with. But back to the whistle-stop tour. Smart grants are an open competition. So they provide funding for businesses in any sector, regardless of the tech or the industrial focus. You get 4 competitions. They're open competitions, run 4 times a year, each time with a funding pot of about 25 million. And there's 2 areas. There's projects of 6 to 18 months for single SMEs or for collaborative projects up to between 100k and 500k. And then longer term projects with up to 36 months. There's between 100k and 2 million available. These must be collaborative. So SBRI is the Small Business Research Initiative. It's a pre-commercial procurement mechanism. And although it's open to all, it's really tailored, it should be said, for SMEs, because what we're doing, we're trying to harness their innovations to solve public sector delivery or policy challenges. So again, quite specific. The SME works closely with the public sector customer. There's usually 2 stages. The first stage is where the SMEs put forward their ideas, their concepts to solve the challenge. And then there is a stage gate with further selection where a small number are given much larger pots of funding to develop the project with milestone payments against the outcomes. And next slide, please. Our innovation loans, as I mentioned, are an exciting departure for us, focused on later stage R&D projects that have got to that stage where there's a clearly defined route for success. It's for single SMEs. We offer loans between 250k to around 1.6 million. It's below market interest rate, so which currently is pegged at about 7.4%, but up to 100% of eligible project costs are in scope. And critically, this is patient funding. So there's up to 7 years available for repayment. So it works across our sectorial focus. And next slide, please. Finally, reference our specific funding schemes. We have our investor partnerships, and I was interested in Melanie highlighting the spending review, because this is an area for us in the spending review, alongside our wraparound support that we definitely will be expanding. It brings together grant funding for those innovative projects with aligned VC and angel equity investment. So investors who have an interest in a specific sector or challenge area, and we're essentially de-risking the equity investment. But this blend of grant and equity is also a really successful mechanism in bringing in great results for follow-on investment. So watch out for how we're going to expand on this offer in the future. Next slide. But it isn't all about the money for us. This is my personal area of responsibility at Innovate UK, because Innovate UK recognised some years ago that it needs to do a lot more than just provide funding. And Innovate UK Edge is our wraparound support service, where we offer, well, I would say intensive growth and scaling support, which is tailored to where businesses are, where they need it to be, where they are in their growth life cycle. And at the risk of stating the blinding the obvious, because early stage companies have completely different needs to one poised to scale, and as Irene pointed out, and the latter group support needs are actually really multifaceted. We offer support that's, although in three buckets of three large buckets of support, so managing innovation effectively, that commercialization journey, we look at how we build investment, funding and finance readiness, and how we can support entering global markets. For the scale-up guys, though, for those exhibiting and qualifying as having the highest potential, we have a scale-up program. And this is a scale-up board, so you've got a matrix of skills and experience. We recognise that for a more sophisticated, complex business, there isn't someone that can walk on water, but there's certainly someone that can facilitate connections for what they need, and to bring in that very focused support that will really make the difference on their scaling journey. So if I could just have a whiz through the rest of the family, the next slide, please. Otherwise, I will get accused of having some sort of internal bias. The Innovate UK Knowledge Transfer Network, which have recently come squarely back into Innovate UK, exists to connect innovators with new partners and new opportunities, which actually we're hoping goes beyond their existing thinking. They really work across sectors and at the intersections of research and innovation. So they're a fantastic source of specialist and thematic resource. And then we have the Catapult Network, the next slide, please, which is a world leading capability. It is the envy of the global innovation community. This allows companies to access specialist facilities and expertise that they need to transform those great ideas into those world-beating products and services. There are 9 catapults across the UK. I won't read them out to you, but they include cell and gene therapy, compound semiconductors, high-value manufacturing, of course, digital satellite applications. They're independent, private, not-for-profit organisations, and they're really looking to enable businesses to thrive, to have that competitive edge in global markets. As part of our response for COVID, we've been piloting the giving of small grants to actually help more SMEs to access these resources. And then regarding those global markets, supporting innovation-driven companies to make global success a key part of their scaling journey is a big, big focus for us. We are looking to help them find international partners and collaborators through our global connections via UKRI, the Science and Innovation Network, and through Innovate UK Edge. We help them to support and understand those new markets and the benefit of the strategic innovation collaborations that they can make. And we do this actually through a couple of programs where we fund the country visits as part of that exploration. One of them is the Global Business Innovation Programme, where as part of the wraparound support looking at their international opportunity in the market, we take them to that market for about a week. And then our Global Innovation incubation programme, where actually we're supporting a company to spend about 3 months in a reciprocal incubation in that country. So all quite exciting stuff. And then I think last but not least, absolutely not least, quite the contrary, Innovate UK is absolutely committed to ensuring we can innovate for the future. And the ED&I agenda is therefore writ large across everything that we do. However, we do have some specific competitions, and these are designed for our young innovators and for women in innovation. We want to find the best and most talented innovators from as diverse a range of backgrounds and provide them with the resources, advice and the self-belief to succeed. And our CEO, Indra Mukherjee, is absolutely focused on harnessing this combination of diversity and inclusion, talent and skills, which, as Irene highlighted, is absolutely critical to a scaler's journey, so that we can help drive forward the full innovation potential of the UK. So it's me. Thank you very much for your time. Look forward to the discussion.
Brilliant. Thank you, Max. Just one question, because you're the queen of the wraparound support aspect of what Innovate UK is doing. I mean, can you just give me insight about what's been the appetite for the Innovate UK edge that you're seeing from scale-ups? And yeah. Do you need to be on the Innovate UK radar before you can take advantage of that program?
No, I mean, absolutely not, Stuart. So I think a good example is through COVID, we sort of, I think, tripled the resource that was available. So we have about 290, 300 specialist innovation and growth advisors that are spread across the UK geography, and about 20 scale-up directors. We've worked with about 6,500 companies in the 2 years since the COVID pandemic bit. And I just had these stats through yesterday, actually, so thank you for this question. About 1,650 of those were Innovate UK beneficiaries. The rest were not. And so these were companies that we provided support. You know, our mission is to make sure that more of our innovators are attractive to investors. They're ready for either investment or funding and finance. And so they're therefore poised to grow and scale. So it's really important that we can get out to, they're not the usual suspects. So we want to talk to the guys that are not necessarily applying to our funding. We can help them apply to that funding if that's what the strategic funding and finance sort of planning may be looking like to support scaling and growth. But so often it isn't about that funding, and perhaps grant funding isn't the best route for them. So that's where how we work with the British Business Bank, how we work with the growth hubs, how we work with the wider ecosystem is so important to us. One of the mechanisms that we're bringing in, courtesy of the spending review, is that we'll be placing ecosystem, and forgive me for this, it's a working title, everybody, innovation and growth specialists. And their remit will be to be absolutely plugged in to regional funding and finance options for innovators. And on the other side of it, to be the, the point of contact for Innovate UK schemes as well. So be able to provide the absolute doers and not just talkers, though, and to be holding the hand of the companies in making that happen. So thanks for that question, Stuart. Actually.
No, I didn't realise I was going to be quite so on the money, but you know. Anyway, thank you, Max. That's great. And if anybody has got questions that they want to put in the chat, we can always you can answer them now or later, and we'll connect you up. So please do take advantage of
okay.
And
unfortunately, I've got to go.
Yeah.
But I'd be very happy to answer any questions that I'm sure that after the panel. Okay. Thank you very much.
Thanks, Max. And now then we can move on to our panel. And if the panel can reveal themselves in some way, shape or form. Yes, there we are. Lovely. Great to see you all. Delighted to welcome David Craig from Isotope, Bob Buckby from London Stock Exchange, Barry Jackson from BGF, Ben Tickler from Silicon Valley Bank, and James Thompson from FinCap. Great collection here today. David, what we'll do is we'll talk with you first, and then bring in our the rest of our panelists. So you can, other panelists can be on screen or not for a short while, if you, as you choose. But David, first of all, can you give us a quick synopsis? When did the Isotope? What does it do? When did it start? What's the big market opportunity that it's addressing?
So I'll answer them in reverse order. So the market opportunity sits around the future scaling of data centers, both inside the data center and outside of it, what we call the edge of network. Very simply, the rate and pace at which we're scaling the amount of data we use is driving a huge growth in processing. And that processing consumes vast amounts of space, vast amounts of energy, and vast amounts of water. So at Isotope, we've developed a technology using liquids that allows us to massively reduce the energy consumption of data centers, massively reduce, well, to reduce to zero the water consumption, to use about 75% less space. And what that does for the clients, it also gives them a technical advantage in which they can continue to use larger volumes of processing, but they can do so whilst meeting environmental requirements. They can reduce cost, and materially also, it actually opens up a real issue for them in solving the problems of locations. They're running out of locations to build and put data centers into. So we give them a really strategic gain through all of those different aspects. So it's something that's very present and growing substantially. So the kind of the market opportunity for us is, it's easy for us to become $1 billion business in 5 to 10 years' time. The TAM for us is a $37 billion marketplace and growing. So it's a significant opportunity. It's significantly there. The business is actually about 14 years old. So like many of those companies out there where, like the overnight success that spent 10 years working hard in the clubs to be there. We're really a story of two halves. The first half we refer to as our kind of more student project phase, where it was the founder and a lot of hard work and hope. And the kind of second half has been where we've had, proper institutional investment behind us, and really significant development towards building relationships with core clients.
And could you give us some idea of the metrics of the business? Number, how many people you're employing, how it's grown?
Yeah, absolutely delighted to. So we've currently got about 54 people. We've been up and down. 2015 or so, there were about 30 heads in the business. We took it down to 18, and we're back up at around 54 just now. We've been a Deloitte Fast 50. 2019, over the 3 years, we'd grown 2,400%, so 24x, which is always sounds grand, but it was easy to do from a relatively small base. But we continue to grow. 2022 we'll double. 2023 we'll probably quadruple. A lot of our stuff's quite long-termish contracts. And then 2025 would probably be another quadrupling again. So there are significant opportunities for us there. And we're scaling up and scaling out just now. We've already got people on the ground in the US, but we'll be coming to the US in fairly significant shape through the middle of this year. We'll be adding more offices and more people there, and we'll also be opening in Singapore and Taiwan.
Wow. So it's this is right at the beginning. That's the hockey stick curve really does.
It is. It's a fascinating time. I've always said, in truth, the most exciting part of a business is the first 50 million revenue. That's the really, when you're getting up to that sort of 10 to 50 million, it's really genuinely great fun. 0 to 10 million is really hard work and a lot of stress. And 10 to 50 million is a really exciting phase. 50 million plus is where it all starts to get corporate and difficult again. So we're really kind of enjoying the 10 to 50 million phase.
Yeah, nods of sympathy there from the rest of our panel. Can you take us through the financing path that Isotope has been on? Because you've raised money from quite a variety of sources, and you're going to say that there's a new fundraising round you're going to announce quite soon. But can you just give us some of the key milestones and why those routes were taken at that particular juncture?
Yeah, so again, in the earlier stage of the business, it was primarily funded through angel and high net worth, which is often the case with startups, and it had a rocky ride through that, because the reality is the market was shifting outwards at that time. It's one of these things where the problem that we're solving, our customers have done a great job of managing to delay the point where they had to change technologies, and they're out of road on that now. It's baked in. So the early part was difficult for the business because it had to rely on those funds, and increasingly that was difficult for it to do because it wasn't generating significant revenues in those days. So a lot of it was really good at getting a lot of people to back it and believe in it. It was very difficult to fill in the IRR charts and spreadsheets in a meaningful way for them, because it was a huge amount of patient capital that was required. And we really shifted to that in late 2014, early 2015. I joined the business in late 15. So late 2014, we brought in a couple of key investors. So one was a London company called Ombu, and another one a Paris-based company called Astor Capital. And that gave the business some proper breadth and depth, and allowed it to start to build out, and hit milestones to continue with that patient capital approach. And so that gave it a much more solid foundation. And since then, we've added more from them, and we brought in another, a family office. So that in the last 4 or 5 years, we've raised about 22, 23 million, which has allowed us to really continue to persist, as I say, very much as a deep tech and an infrastructure-based thing. We're not an instantly attractive space to most of the money out there. They love software, they love all sorts of things, but deep tech and patient long-term contract wins are harder to fund. So we've had the right kind of backers through there. And we've built out, again, we really focused hard on the biggest players in the industry. So we focused on sort of like 10 or 15 companies that represent 75% of the market. And we've gotten really, really super deep with, 2 of the biggest cloud players in the planet, with Hewlett Packard and with Lenovo, and also with the big silicon guys. So these are all 4 and 5 year long relationships. They take really hard work to build and develop. But that's allowed us to build now to the point where the round that we're closing soon is very heavily VC backed. We've got 2 major sovereign wealth funds playing a very significant strategic, and we're allowing the final 2 or 3 to have a bit of competition between themselves for the last slot in the round. But we'll be raising more than we've ever raised in the past, put together. And it's all about scale up and scale out. But it's a truly international syndicate. So, we've used a variety of sources, but they've been appropriate for us at the time. But I would emphasise for us, it's been patient capital that's been essential to us.
Yeah. But what has been the particular challenge of finding that right type of finance? I mean, was it easy to connect with investors who've got that degree of patience? How many frogs did you have to kiss?
There's a fair amount of frog kissing that has to go on. So, the obvious frogs are sometimes there are large funds that are in the, we really do want to work with smaller businesses like you. We promise we can, and no, they can't. They're definitely much more geared to looking at mezzanine finance and beyond. The deep tech side of things is often a challenge because it can be a bit of a many-headed hydra. You really have to get people down into understanding quite complex IP, and a lot of funds are just not actually geared and just don't have the talent, frankly, to understand. I don't mean that in a negative way. They just don't employ the kind of people who can really get their heads around that. And as I say, there's software, stuff like that. If you're in the zeitgeist pieces, it's quite easy to get those things. And I mean, we've noticed in this last round a huge amount of interest from people around ESG. Now, a couple of years ago, it was pure lip service on ESG. We could talk about, I mean, we probably stopped talking about it to some extent because nobody cared enough. Now the funds are all really hammering ESG. So it's changed. So being in the zeitgeist is definitely part of it. But having a technology where you're getting revenues in from very exciting clients, but you're not yet deployed in scale, etc. There's a lot of potential energy, and that gets everybody excited, but it also makes it very difficult for most ICs to get some kind of backing put through. So we've had to build real track record and really strong relationships to do that. So it's not been easy to find them, but they are there.
Yeah. And how do you ensure that, given the patience that's required, that the early investors don't ask for, want too much equity, that you've got enough in the capital structure, that there are enough in place for later investors? So
that's a great question, and the problem is, in some respects, we didn't, and that was part of the earlier challenge of the business. That it's fair to say that the founding team were somewhat promiscuous with their equity, and it has created challenges. Some of the early angels and high net worthers are no longer shareholders in the business. And we've had to find ways to buy them out and remove them from it because their ambition, the difficulty was that they themselves didn't have the means to continue to grow funding the business, but they found it very difficult to want to dilute. So the honest engine side of that is it can be very difficult, and we've just had to be big and brave and deal with that, and that's involved secondaries and various other routes as we've gone through things to do that. But we're now at the point where the incoming round we'll have a fairly balanced cap table between existing and new money coming in. Management will have a good and acceptable chunk of the equity as well, but it's taken time to get us to there. We're having to see existing investors, create space for more equity for management, etc., to do that. But the upside is strong, so it's worth their while. So it's been a bit of a tortuous path, in fairness. And what I would say to any early stage investor is, it's really difficult to get the kind of exit that you want, and you kind of have to find a way to recognise that incoming money has to be accommodated. So certainly for us, a high net worth individual who thought they could get rich in 2 or 3 years was going to be a disappointed person, and that was probably in earlier stages of the business. I think that was probably oversold, and an inability to be honest with each other about what was right would have been present at that time. That's not the case now. And we just have a pattern of kind of under promising and over delivering. So we tend to stick with that approach, but it is a challenge to get to. And sometimes you've got no choice. We had a phase where we literally only had one suitor, and it was the only one we could use. You're left where you're left.
So thank you, David. Look, this is really interesting. Well, I think we could carry on talking now for the next half hour, but I've got a panel sitting waiting as well to join us. And So I certainly want to come back to you about the ESG, your comments there, at probably sort of at the end when we wrap up. So I'd like to get a collective view there, and also hold this just from about the role of the board in changing the board, in having the right board in place to help on the scaling journey. But I'm mindful of making sure that we, and especially with your warnings about not being too promiscuous with your equity. It seems like an obvious time to talk to our advisors here. Bob, maybe first? I don't know. There's so much knowledge. Bob, just give us quickly the context of from the stock exchange point of view about current trends in IPOs and on AIM and the main market in the regions we're here in, Yorkshire, Humber, Tees Valley, and the Northeast. And but I'd also be interested to get your reflections on kind of what David's the financing journey to date, and what observations you would make on that.
Brilliant, thank you, Stuart, and great to hear your story, David. Thanks for sharing that. Look, I'll keep mine brief. The stock exchange has been very, very active over the last 12 months as we've come out and sort of emerged from Brexit and then COVID. We've seen a really unprecedented level of activity and new companies coming to market. We saw 126 IPOs in London last year, and that has really been reflected regionally as well. I'm really pleased to say. So very strong investor appetite to invest in earlier stage growth businesses, often founder-led, and across the regions of the UK. So working hard to try and identify exciting growth businesses to receive capital that would otherwise be sat in London. And that's why the exchange has been busy hiring ex-advisors and bankers like me to help try and connect those companies with that capital. In terms of the sort of regional activity, 20 of those 126 IPOs have been in the north of England and Scotland, and looking at the northeast, Yorkshire and Humber, there were 7 IPOs last year. So really quite active. And what I would say is that whilst a typical AIM IPO might be around 80 or 90 million pounds market cap, actually we see a lot of activity at the smaller end as well. So of those 7 in the northeast, for example, 3 of those were in the 20 to 30 million market cap bracket, and often pre-revenue. These are technology businesses with some interesting IP that are just getting to that stage of commercialization, or a bit further along that journey, like David is, looking to then come onto the public markets.
And are there currently, I mean, you mentioned there a couple of it, but are there particular sectors that are currently, are very much in favour with investors?
Well, the public markets are a very broad church, so we're seeing activity all the way from the sort of software businesses that David was mentioning, through to distribution businesses and more traditional business, all getting good support from the public markets. I would pick out probably the green sector, so looking at anything with a sustainable model, something which is introducing a new system process alternative to an existing technology which does it at a lower carbon cost. 3 of those 7 IPOs in Yorkshire and the Northeast were a green tech business, and we're seeing increasingly funds focused on really only investing specifically in businesses with those green credentials.
And I know that this is kind of about an education session about dealing with providing facts and data. Are there any still long myths, misperceptions held by those people running scale-ups, running high growth businesses about IPO, the IPO process? About what's the most common misperception that you face or have to confront?
I think I'd pick out two. One is that, oh look, we don't want to have to spend all our time in London and building a relationship with the city and messing about with stockbrokers and all that. That's sort of a cultural sense that it's not right. I can see David smiling there, and actually, the feedback then that we get from our listed companies is that actually they can quite happily manage that relationship, and you don't actually need to set foot in London at all now, even to IPO your business, let alone do that investor contact now with the likes of Zoom, etc., and the digitization of going public. And then I would say the other misperception is we're just not ready. We're not big enough. We're not corporate enough. We're still founder led. Over a quarter of all the IPOs on the exchange last year were founder led, and many were at that early stage. And if you've got a business and a model that you're confident there's going to be consistency, and you're going back to the markets and saying, look, this is what we're going to do, and then coming back in 6 months' time and you've done it, then you don't need to feel that you need to be a certain scale in order to be ready for the public markets.
And I see there's a question that's come in the chat from Jonathan Gold. Why the IPO rather than just raise larger rounds from VC and PE? So I should probably hit it straight at you, Bod, and then then I'll use it.
It's a great question, and it's one that different companies and different individuals will come to different answers on. I think the reasons that we see some founders wanting to list their business are around perhaps trying to keep a greater control over the equity. So there's some, as you certainly go up the scale in terms of private equity, they typically seek to take larger percentage of shareholding and greater control, and some founders would rather keep that control. And then there's a sort of a wider question really around the fact that for most private equity investors, they have a preferred timescale and horizon for how long they want to invest, and after that you're going to need to go through a process and find a new partner and suitor for the business and bring them in and go through a sale process, whereas an IPO is permanent capital.
Thanks, Bod. We'll pick up on some other points as well. And there's one specifically to you in the chat about the Tees Valley, which you may want to address there. But maybe I can bring you over to Barry from BGF. Tell us, Barry, tell us a bit about the investment activity of BGF in these regions, and who have you been investing in and why?
Yeah, thanks, Stuart. Good morning, everybody. I mean, very similar themes really to what Bod has been saying. Coming out of COVID, there has been a very big increase in M&A activity, and I think there's a number of factors coming together that's driving that. Part of it is businesses that have fared well through COVID, are looking at it as a good time to raise capital, because actually they've shown themselves to be very resilient in the face of a pandemic. The other reason, certainly more so last year, was entrepreneurs fearing CGT changes, because BGF will typically provide growth capital to companies, but often de-risk shareholders at the same time. And certainly that fear around CGT drove a lot of activity in the early part of 2021. And I think the other factor, to be frank, is entrepreneurs have had a very big shock during the pandemic, and it's possibly caused some of them to accelerate their thinking towards either exit or de-risking. And again, that sort of come together and driven a lot of activity. In terms of this region, I mean, BGF, we have an office in Leeds, we have an office in Newcastle where I am today. We invested more than 40 million in the region last year. So we backed 4 new businesses, of which 2 were in I guess, Teesside and the Northeast. We've actually had quite a number of successful exits, and there was a great success story in this region locally, a business in Hartlepool called J&B Recycling, which was a family-owned business that we invested 7.5 million into in 2014, and that business has grown 5-fold over the period. And ultimately, it was management, the family decided it was time to exit, and it was sold to trade. So a very good result for the female CEO and founder there, Vicky Jackson Smith. So the region continues to be very active for us. Individual sectors. I mean, everybody will talk about tech as a somewhat bulletproof sector throughout COVID, and that there's just lots and lots of activity. There's an increasing amount of activity in the green tech arena. For us, a lot of those companies are slightly too early stage for us at the moment. We tend to invest in more established businesses, but we are seeing a lot of those opportunities come through. But as I say, just generally, I think the levels of M&A and funding activity last year were certainly a lot higher than anyone could have predicted on March the 23rd when the first lockdown came in the year before.
And just to about what's the pipeline looking like in terms of promising scale-up businesses? How confident are you about the pipeline of exciting scale-ups that you can fund in 2022?
I think pretty confident, Stuart. I mean, the activity still seems to be strong. I mean, BGF, we're talking to lots of different businesses at various stages all the time. So, we are continuing to see a steady flow of businesses, and they can be anything from early stage businesses. So, a good example of that was a business called High Comply, which was largely pre-revenue SaaS business, so quite unusual for us to invest at that stage, that we invested in the Northeast last year. And again, the funding there was essentially to provide scale up. So we are seeing a continued flow of those activities. I would expect this year, if I'm being honest, I wouldn't expect this year to be as busy as last year, just because it's hard to see that being repeated, but I would still nonetheless expect it to be pretty busy.
Thanks, Barry. But James, can you get your perspective on this? And I wonder whether is there a mismatch, I think, between the perception among scale-ups about what capital is available to grow and actually what is available? What's your view?
So I think rather than being the availability, I think it's probably the ease of access, which is the biggest sort of hurdle for scale-ups. As sort of David said right at the beginning in his sort of early sort of funding rounds, finding the right high net worths or experienced investors that could invest in the long term is probably the hardest thing to do. And whilst the availability of capital is increasing, it's the murky world of a friend of a friend who sold a business and is now a millionaire is now investing in businesses. That's changed to sort of angel investing clubs, high net worth clubs, crowdfunding, those sorts of things. So I think the platforms are available, and I think it was maybe 5 or 6 years ago where private funding overtook public funding for the first time in the UK. It's all about trying to find the right people to invest in. And again, as David said, it's not an easy process right at the beginning. It's kind of scattergun, pick who you can get the meetings, and then people will get it or people won't. But it certainly in the first instance, it's a very grueling process, and then as you develop, it gets easier. There are other intermediaries you can get involved to help you with that. But on the availability side, I'd say actually availability is better than ever.
Is there anything, though? I mean, it can sound like it's quite a hard and random process. What do you do as advisors to help scale-ups find and access the right investors for them?
Sure. So I guess FinCap in its inception was originally focused on listed businesses only. We now have a sort of private capital team that deal with sort of Series A and Series B. And it's, those people have the networks amongst the investor community, whether it's, smaller VCs and private equity or high net worths. And then we basically do everything from simple making the introductions, then also, revising the investor deck, teasers, all those sorts of things to try and alleviate some of that stress off, people trying to scale their business where they haven't quite gone through these sort of complicated funding rounds before.
Mm-hmm. So, I mean, Ben, can I bring you in on this as well? I mean, again, a bit of context about Silicon Valley Bank and, kind of the lending activity that you've been doing in the regions, and whether there are particular sectors to which you are lending, just to give us that kind of context first.
Yeah, no, thank you, Stuart. And yeah, fascinating, David, sort of at the start, and appreciate all the great questions. So I think for us, I'm actually going up to Manchester tonight. So we have, I'm seeing 3 or 4 clients. So it's, the north we cover, we have 1 person in Manchester. So there's much more to be done. Obviously, there's a huge sort of regions to go after, but Silicon Valley Bank purely focused on innovation. So we mentioned tech, and I would add on to that life science. And when, we're a commercial bank and do different forms of lending. I think a couple of really interesting deals that also then links into, what we're seeing. So we supported, and actually we came in with NPIF and Maven Equity Finance, for those of you that know them, on a company called AppLearn recently. We did a loan for Arctic Shores, who have grown 50% year on year. So these are both 2 Manchester-based companies in what I would call a sort of HR tech future workspace. But to David's point, they are software and I guess, backed by VCs. We also helped sort of linking into what Bod was saying, Music Magpie, so pre-IPO, I think Stockport based, and listed for about 200 market cap, but help them. So we're doing selective deals. We have someone in Manchester, lots more to do. I used to focus on Bristol. I'm now doing more up north. So we're trying to do more. We're trying to do
have to get you across the Pennines and
exactly, and bring the brand, and we heavily rely on the network up there, right? Because it's, you need to be visible, you need to be there a lot. So working with great partners and being Innovate UK or Maven Equity Finance, MPIF, just being introduced to the local teams are really important.
And one thing which may be helpful for some of those in on the event today, what's the difference between venture debt and conventional bank debt?
Yeah, so I was only used to conventional bank debt till about 5 years ago, and then made the transition. The easiest way I would position it is conventional bank debt. Financial institutions are lending against what money you're making. Your EBITDA or your cash flow. Your bottom line. Or institutions are lending against your invoices, they're lending against your balance sheet. And venture debt is all about lending against your enterprise value. So it's for those companies that are raising institutional rounds. They're raising from venture capital funds, and then the debt is to complement that equity, because most of these companies are looking to grow very rapidly. I think Bob made a comment about venture capital funds are coming in for a duration, they're looking for a certain return, and so venture debt is to complement that equity and turbocharge growth. But you don't need to be profitable. In fact, barely anyone I work with is profitable. So that's a key misconception and difference with bank debt.
Thanks. Now I'm going to try and hard to avoid, although the discussion about is with tech there and with David's story from Isotope, but maybe just to sort of try and broaden the lens here a little bit. And one of the things about raising and taking equity finance is about the perspective of loss of control, or the sort of something. Does the issue of loss of control still hold scale-ups back from taking equity finance? I'm going to put that to Barry, but first to James.
I mean, loss of control is a big point, as Bod highlighted. Actually, for us as a sort of a bank that focuses on primarily on listed businesses, it's a great argument to convince a company to float rather than go with private equity. But it's a difficult one because you can see it from both sides. People who invest in the business want to be able to have some control over to where their capital is going, what their business is doing. But management teams as well want to have the creative vision over their company and keep driving that forward. So I think it all comes down to the capital you're going after. I think if you're going after private capital, then you have to give up some of that control, and there's less of that if you go down the public markets route.
Barry, how does loss of control sort of feature in the conversations you're having with scale-ups?
Yeah, I mean, it's usually the biggest point of discussion, to be honest, for entrepreneurs. And I mean, where BGF sits, we're slightly different to mid-market PE. We are a non-controlling minority investor. But that doesn't mean to say that we just write a check and then we disappear off into the sunset. So, there's still an investment agreement there. There's still a shareholders agreement. And there are still different things in place that are there post-investment that wouldn't have been there before. So I think for entrepreneurs, I think sometimes what the misperception is with private equity is that, if there's a legal document there that says they could do all these things, then, they're kind of going to do those things at the first opportunity. And that's not the case at all. And, in any sort of equity investment, there is a leap of faith on both sides. And at times, I think entrepreneurs possibly don't always sort of understand that because they're quite new to it, but there's as much of a leap of faith from the investor as there is from the management team, because whilst, yes, the investor might have a legal agreement that says they can do X, if you're pulling the legal agreement out of the drawer a few years into the investment, that generally means that things haven't gone particularly well. So it's just about, it's about founders meeting a number of investors, spending some time with them, probably referencing them on deals they've done before, doing all the normal stuff you would do when making a big decision, and taking advice as well, and ultimately getting themselves comfortable that this is the right type of investor that they want on board. But the point is right, Stuart. I mean, loss of control is a huge point for entrepreneurs and entrepreneurs that want to stay in absolute complete control and have nothing change. Equity investor, institutional investment isn't for them, to be honest. So there is, no matter even with BGF, who we're a benign investor, there's always going to be some loss of control.
And I wonder whether there's some, and just to stay with you, Barry, about and because we've been talking a lot on tech, but there's clearly the sort of the manufacturing sector is very it's really active and strong, as we saw from the British Business Bank presentation in these regions. Are you seeing what's the sort of the degree level of interest and the discussions you're having with companies in sectors that are not immediately labelled as tech?
Yeah. I mean, it's a good question, Stuart. So, I mean, BGF has invested quite heavily in manufacturing, over the last 10 years, particularly in the Northeast. Businesses like Chemoxy in Teesside, which is a specialist chemicals business, and Arkinova in the Northeast, which is a pharmaceutical business. Those have been very successful investments for us. I think the key is, as it is with any business, but particularly with manufacturing, is is it specialist? Does it have something that's a bit different, that's quite defensible? And if there is, there's absolutely a case for it seeking equity investment. I mean, there's no question that the whole stating the obvious, the manufacturing sector over the past 20-30 years is much less of a force than it was before. But there are still good investment opportunities in that sector, and I suppose what this region is good at is producing manufacturers that are innovative and bring something different to the market. And if they do that and they want to raise equity finance, there'd definitely be a case for doing so.
Yeah. And this is one which possibly goes to all of the it's the panel, and then I'm going to come back to David. Are scaling businesses always as well prepared as they need to when they are actually making that the pitch for accessing your finance? What could be done better And I maybe a Barry, but then also I'll take in Ben on this first of all.
Yeah, I mean, again, it's what you would expect. It's preparation, and you know, for anybody that's going through a fundraising process, frankly, even if they've done it before, you know, I would always sort of encourage to at least speak to advisors and, you know, get some different views, understand, you know, what their options are, and depending on what type of fundraise they're doing and what capabilities in the business, they might get an advisor to support them throughout that journey. Where things can come unstuck quite quickly is, you know, when people have pretty limited experience and they sort of forge ahead on their own and go out to market and talk to lots of different funders. And those initial conversations are absolutely critical. And if you don't get those right, you know, it can be quite hard to change people's perception of the business or the opportunity. So I suppose that's the key takeaway I would say to people. If you are thinking about funding, you know, at least talk to some advisors who understand that space and garner some views.
Sounds like a sensible suggestion. James, and then Ben, possibly. James, would you pick up on that? Are you seeing, do you get the right questions being asked of you early enough?
So I think if we go back to the beginning, I think that what people really want to see is kind of a management team who understand their business, the sort of pricing pressures, the supply pricing and how that affects the business. And the easiest way for that to be reflected is in the financial projections, right? So we've all seen sort of the Dragon Den episode where the dragons ask numbers and people start faltering, and it's very hard, as Barry says, to sort of come back from that position. So I think certainly in FinCap, we sort of have a team that engage early with businesses that could be sort of 2 or 3 years out from float, and help them with things, you know, such as, you know, financial modeling, putting a board in place, making sure that sort of all the bookkeeping and accounts are in place, and it's all about that first impression, as Barry says, and making sure that it's done properly and done right.
Agree, Ben?
Yeah, I think it's a good analogy. I guess it's being prepared about financials. And if we take venture debt as a solution, it's typically done alongside equity, right? So a lot of the information is the same, but it's being prepared that, you know, people will dig into your business. And I would say timing and options, even something like venture debt, you know, Europe is a lot less mature than US. So it can mean very different things to different lenders, depending on whether they're just starting out now, whether they're a debt fund, whether they're a commercial bank. So, you know, getting in there early and having conversations and actually working out what a facility might look like. And then, being really transparent. And I would say investing in your finance team. If you really want to go down this journey, don't have your finance team be one person trying to, you know, raise equity and pitch to investors and take on debt. It can be very stressful for them. So that's a pitch to, you know, keep investing in your finance team.
Thanks, Ben. David, I'm going to come back to you partly because that's a very helpful segue about the importance of having the right board in place as you were scaling the business. And I'd be interested just to get brief observations on how you've gone about that. And then secondly, and then this becomes a wrap-up question, is how important has been you mentioned ESG before, how important has the ESG story for Isotope been in talking to investors?
So first thing, I was nodding a lot when the guys were speaking there. I think genuinely, truly, just to capture first the value of a good advisor is not to be underestimated. You know, as we've gone through these rounds, having somebody present with us who can help us really build out our models, really build out our presentations, and help us, you know, network to the right kind of investors has been a significant feature. You know, we know a lot about our business and we present it well, but it makes a huge difference to have that. And to me, it would be a false economy to try to miss that piece out. So we've been, I think good advice is just something that's massively important to have in place. I suppose board, we've got a good board. Now, I actually joined the business as a non-exec because its board was chaotic, and you know, I'm on record in minutes at the time telling them they were chaotic, so I'm not telling tales out of school. And we had an unpleasant dynamic. We had a high net worther that didn't want to put more money in, didn't want to dilute. We had a couple of, you know, proper professional funds in place, and there was a lack of trust. And they spent hours and hours just arguing with each other, whilst actually not focusing on the business. In the meantime, the business was actually not performing well at all. So my starting point was actually to come in as a kind of independent that could help knock heads together. And being a boy from Glasgow, knocking heads together came very easily. So it was very important to do that. And we had to detoxify the board, and that, as I say, we had to you know, use vehicles, etc., you know, properly and correctly, but we had to invite the high net worther effectively to leave. And we had to work through that, you know, with those guys going on, and that's allowed us, you know, really strong alignment with board. We've made sure that we've got a well governance focused chair, and we've also been able to attract significant industry individuals as non-exec. So we've got sensible independence on board. We've got I'm one of those ones who I over communicate to the investors, so we're not just talking to each other at board meetings. I talk to them all the time, and it means that we've got a much more involved and engaged process through board. So board for us is highly supportive. It's a strong place. It's not, the business doesn't feel curtailed by board. You know, I think that's the point, you know.
Yeah, thank you, David, because I'm mindful of the time. We've got very little time. No, so ESG, how much are you allocating? How important is it? And are you allocating more weight to ESG considerations as investors? I'm going to put that on quickly. First of all, to Barry.
In short, yes, Stuart. So ESG, I think it falls into two buckets. There are clearly green tech companies that their purpose is ESG and to improve the environment. But across the board, in every single business that we invest in now, we closely consider the ESG credentials of the company, and we form a view as to whether we think they are doing the right things, they are thinking in the right way. And it's a pretty important part of the decision-making process now.
Bod.
So on that capital raise last year, if the green economy were a sector in its own right, it would have been the third largest sector by capital raised on the exchange last year. So it's become huge.
And James, finally.
Yeah, I think, I mean, if you look at the floats, as Bold said, if the floats have happened over the past sort of year, it's been technology, life sciences, particularly things focused on upper respiratory diseases, and then it's anything that's green. But I think from looking at it at another angle, investors also look at non-green or sort of or companies that are not focused purely on sort of the green element and exactly what they can do from an ESG point of view, and yeah, everyone appreciates that a scaling business can't divert all of its funding into getting sort of chief climate officers and all that sort of stuff. But there are very very easy things you can do, like monitoring your waste and your energy, electricity, putting in sort of basic policies in place that I think people want to ask about.
And there are very easy things I have to do, which is to get this finished on time. And it's just a thank you all to David, Barry, Bod, Ben and James for a fantastic session. And thank you. And now I'm going to hand you back to Irene for the close.
Thank you, everyone. Let me add my thanks to the British Business Bank and to our experts there and David to give his time out of the business to really give some very insightful feedback. There's a little poll come up there for you to complete before we close the session. So do just flick in what you would like to hear more about in such sessions going forward. I hope you found this session useful. We will share, as we've said, the decks that were used and this video recording to share with others by the end of the week. And we do hope that you keep your questions flowing in the future and keep scaling up. You know that capital is there and it can get connected to you. And we're here to help that process with the British Business Bank and Innovate UK. So have a good day and thank you again, everybody, and look forward to seeing you all soon. Bye-bye for now.
Thanks very much. Thanks, guys.